Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining us for this segment, we have Steve Wyett, chief investment strategist at BOK Financial, and we're here to discuss if Friday's employment report provided any insight into the Fed's rate policy path and if the U.S. election is starting to impact markets. Steve, it is great to see you as always. Welcome back to Trade Talks.
Thank you, Jill. Pleasure to be here today. Look forward to our conversation. Thank you.
You got it, and same here. And what did the employment report tell us, or did it not tell us in terms of the path of rate cuts? I feel as if the Fed has been pretty clear in telegraphing their message, and it seems as if they're shifting more towards employment now, perhaps than more of the inflation conversation that we heard earlier in the year.
Yeah, that's exactly right, Jill. Look, at the Jackson Hole conference, Fed Chair Powell started his speech with being about as clear as he could be. The time has come for policy to change. He mentioned that they don't seek nor welcome further weakness in the labor market. So clearly that shift in focus away from inflation and toward the labor market. And to that end, we were hoping that the report that came out last Friday might give us some clarity on that 25 versus 50 basis point debate that we're in the midst of. Direction's clear, path is where we're having this conversation. Unfortunately, I'd have to tell you, it just didn't. The non-farm payroll number missed. There were downward revisions to the previous 2 weeks, and this is on top. Remember, they did the annual revision where they reduced the number of new jobs by something like 818,000 jobs. So there's signs that the labor market's continuing to weaken, but we're still positive. Unemployment rate ticked down 0.1%. And really, from our lens, the thing that was kind of the fly in the ointment, if you will, is that average hourly earnings came in 0.1% hotter. And so, yes, as you mentioned, the Fed is shifting its focus from inflation to the job market. They're not going to give up on that fight for, against inflation, and wages is a key aspect of that. So I think we were left with a number that it was still up in the air. The markets didn't react really positively to that. The bond market interest rates fell pretty dramatically. The stock market gave up a lot. Now we're reversing some of that today. But from our lens, we still think it's a 25 basis point cut. But there's a strong case to be made for 50 basis points. It's maybe the CPI and PPI that come out this week will be the tell on where we finally come down on that.
Yeah, and Steve, a couple things here. If we were to get, let's say, even 3 to 4 rate cuts, which a few investors are trying to price that into their models, to me, that would be more unnerving than anything else if their focus has shifted to the employment market. Inflation is one thing, but if jobs are in a decline where consumers are going to lose their livelihood, to me, that's a little bit more concerning than jockeying in on how many rate cuts we're going to get. And then the second question to that is, do you think the markets are challenged in interpreting what these reports mean? Because the revisions have been quite glaring. Why is this happening with the data? Is the model outdated? Are there ways that economists should be looking at this?
I wish I had the answer to that, but I think it's something like 18 of the last 21 employment reports have been revised downward. And when you think about the billions of dollars that are traded based on this number, it's probably the most important number that we get on a monthly basis. This daily move is on Employment Friday, but I wish I had an answer for that. It's hard to say. This is where we've discussed, if we're missing something from the big surge in immigration, if there's something in the way that we're collecting the data that we're just not getting as clear a picture as we did before. But I think that's one of the confusing factors as to which direction the Fed is supposed to go. It's, Jill, how the Fed is easing, why the Fed is easing, getting back to the first part of your conversation. This is, if the Fed can do 25 basis points, that's the standard move. If they go 50, you got to wonder if are they more concerned about, unemployment has this history of moving in a non-linear fashion. That is, it starts up kind of slowly and then accelerates pretty quickly. That's not the base case. But we did trigger the SOM rule last with the previous employment report. That has to be on everybody's mind. If the Fed is having to ease aggressively because economic growth is sliding towards a recession, that's just a much worse type of a scenario than if they're able to move slowly, economic growth remains positive. It's definitely slower than what it has been, but we're not in a recessionary trend. That's a lot friendlier market type of an environment. That's the soft landing type of environment that we've been hoping for, and not a hard landing where then the Fed is aggressively easing, trying to staunch the tide of really declining unemployment or increasing unemployment.
Well, Steve, let me throw another curveball at you then. The yield curve is uninverting,
Sure.
right? And what we expect it to happen with an inverting yield curve didn't necessarily play out. So is this a good thing or is it a bad thing?
Yes, it's a good thing or it's a bad thing. Again, it kind of depends on how it's occurring. Now, it's been happening relatively slowly. I think for the week, we closed in an uninverted basis for the first time since like June of 2022. Again, if the Fed can be patient in their approach, if they can use 25 basis points a meeting, use their communication process to say, hey, here's where we're going, and the market can kind of build that in over time and not have to worry about the Fed getting overly aggressive. That's where the uninversion of the yield curve historically has been at the onset of a recession, is because the Fed's easing significantly and driving those shorter term rates down. So look, the 2-year to Fed funds inversion, where Fed funds well above the 2-year, those are at levels that we haven't seen for a very long time. So they do need to close that gap. That is the bond market telling the Fed that they are being overly restrictive at the present time. But again, man, just look at, you still got GDP growth on a positive side. Service sector numbers continue to look okay. There's nothing out there that's just screaming that we're looking at an imminent recession, and for good or bad, short term, at least for the good, we continue to spend a lot of money from a fiscal standpoint too.
Yeah. Well, let's ask another existential question here. I'm going to give you these either ors all day long here, Steve. When you think about leadership in the market with sector rotation, perhaps taking a more defensive posture, does that indicate that perhaps stocks are interpreting this in a more not quite as positive manner? But then on the flip side, you wanted breadth to improve, and now it is because it's broadening out. So how do you interpret that?
Yeah, the leadership has gotten more defensive. It's towards the interest rate sensitive sectors, the financials, the utilities, the REITs, healthcare doing better now. Tech had such a huge run. In one sense, it's kind of like, man, just take a breather here. Let's let the rest of the market catch up a little bit. And to that end, we haven't seen a major shift in earnings expectations either for the rest of this year or into 2025 at this point yet, Jill. So we think this is a bit more of a broadening of what we're doing from a performance standpoint. And frankly, look, this is where we're going to have to maybe jump into the political side of things. As you look at some of the platform differences on taxes, there have been such humongous gains in some of these tech companies that if you're worried about tax rates as we get into 2025 and future, it wouldn't be deemed imprudent to be trimming some of those gains that you've taken when tax rates are probably as low as they're ever going to be. I'm not saying that we know that they're going up, but it doesn't appear that they can go down a whole lot from here either.
Yeah, well, I think that's probably what the market is grappling with as well. So what your opinion, if the election cycle is starting to impact the market and investors, it seems as if it's still a challenge discerning what policy could play out on either side of the ticket, because it seems as if when poll numbers come in and they're adjusting their talking points to satisfy a specific audience, it makes it hard to determine, what policy could look like. It feels as if things are just very transactional, and a longer term strategy is hard to discern here.
Yeah, look, I think the biggest thing for us from what's happening from the political front at this point in time is that we've just reintroduced a higher level of uncertainty. Since the change at the top of the Democratic ticket, the outcome of the election has become a lot more uncertain. It's it's pretty much a toss-up at this point. But beyond that, then, Jill, we know that as broad as the policy differences are between the two platforms, it comes down to what the makeup of the Senate and the House is going to be as it pertains to what is actually going to be able to get implemented. But I think at the base of this too is there's this sense that if at least historically we've had this idea that gridlock was good, I'm not sure that's the case. I think we're on a path now where everybody kind of understands that from a fiscal standpoint, it's unsustainable over a longer period of time. So there's going to have to be some change that's going to take place. We're going to have some way to get our expenditures and our revenues back closer to in line. I'm not saying a balanced budget. I don't think that's realistic. But running 6 to 7% annual budget deficits when you've got positive GDP growth and unemployment below 4.5 would be that's just kind of almost irresponsible. So how you do that combination of revenue increases, tax cuts, tariffs, that's where all of the policy ideas are being thrown around. And you've got people that say, well, but if you make under a certain amount of money, don't worry about it. It's not going to impact you. They're throwing around policies that only impact a relatively small number of people. But in the end, the numbers are pretty big, Jill, and it's really hard to see how we're going to make any real headway unless the way I put it in the presentations I'm making it to my audience is I think we should all be prepared to be part of the solution in some way.
Yeah, I think it's a great point that you make, because I think it's irresponsible to say that it's not going to impact most of us. It's only going to impact a few. Well, guess what? If it does impact corporations, they have to think about their fixed costs in terms of hiring and where they're investing money. It will trickle down to the consumer in terms of additional costs that are added on. So whether the tax rate doesn't impact you directly, it will somewhere within the economy. And I feel like there's got to be a better way to telegraph that versus saying nothing's going to happen to you, right? I mean, I know it's off topic here, but
yeah, and really, Jill, what the problem is that we've got some things that aren't easy to solve. There are some things that we need to get done that don't fit neatly into like a 15 or 30-second political soundbite or commercial. And so this is where we need serious leadership that can look at some of these issues and understand that this is going to be something that you're just not going to be able to put out a 30-second commercial and everybody's going to understand what you're talking about. So this is where I think we all just need to hope that we get some serious leadership in Washington that can attack some of these issues. I'm not saying one way or the other. There's multiple ways that we can go forward from here. But at this point in time, I would just say, particularly in some areas, gridlock is not what we need. We need some solutions to some problems that we face.
All right, Steve, appreciate your insight and wisdom as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.